I greet you once more, ladies and gentlemen. I prepared to share with you a set of notes on the balance of payments. So in this lecture, we're going to look at the accounting basis of the balance of payments and the key elements of the balance of payments. I briefly mentioned the balance of payments when I was concluding my lecture on international trade, so I'm proceeding from there. The balance of payments refers to a record of the economic transactions between the residents of one country and the rest of the world. In other words, residents of other countries, all other countries. The balance of payments are compiled using a double entry accounting system. So each transaction is entered twice so that we have a balance at the end of the day. International transactions involve the exchange of goods, services, or assets between residents of one country economy and those of another. So residents, this refers to businesses, corporates, non-corporates, incorporated welfare entities, individuals, and government agencies that from time to time participate in international trade. Those reckoned as residents make the country in question their legal domicile or their legal country of residence. So credit transactions associated with the plus sign, these are receipts of a payment from foreigners or from foreign residents, either for goods or services, or goods and services. And then the debit transactions associated with the minus sign. This is payment to foreigners or foreign residents for services rendered by those foreigners or for goods purchased from those foreigners. So Zimbabwe's credit transactions, they include merchandise exports, brings in forex, transport and travel receipts, income received from investments which were done abroad, maybe in the past, gifts received from foreign residents, aid received from foreign governments and foreign aid organizations, and investments in Zimbabwe by overseas residents. All of these are credit transactions that are associated with credit entries as opposed to debit entries in our balance of payments accounts. And then the debit transactions of Zimbabwe include merchandise imports as opposed to exports, transportation and travel expenditures as opposed to receipts, income paid on investments of foreigners. When foreigners invest in the domestic economy, later on, income is paid to them. The income which is paid, which is to them, is a debit transaction from our accounts. And then we've got gifts to foreign residents, and we've got aid given by the Zimbabwean government. And we've got overseas investments by Zimbabwean residents, which cause an outflow. So debit transactions are associated with outflows, and credit transactions are associated with inflows. So the total balance of payments accounts must always be in balance as a requirement of national income accounting principles or systems, like the UN System of National Accounting of 1993 and subsequent revisions. They stipulate that the balance of payments account must always balance. So a surplus, a balance, it will be a balance on a sub-account or sub-accounts, which is positive, and the deficit is the opposite of a surplus. It's a balance on a sub-account or sub-account, which is negative. So what is the international payments process, which is associated with importation of goods and also exportation of goods or the exporting of goods to other countries? Importers in a country pay the exporters in that same country in the national currency. In reality, importers and exporters in a given country do not deal directly with one another. To facilitate payments, banks carry out these transactions. So it's the Forex division or the International Trade Division of the country which specializes in that. The structure of the balance of payments, we've got it has got two major components and two minor components. The two major components are the current account and the capital account. And the minor components are the official reserves account and the statistical discrepancy item. So we've got the current account, that's the largest component of the balance of payments in many countries. It records the monetary value of international flows, transactions in goods, services, income flows, and unilateral transfers. All of the goods Zimbabwe exports or imports, such as agricultural products, machinery, autos, petroleum, electronics, and textiles. Merchandise trade balance. A credit is registered as a positive associated with exports, and a debit, which is really an outflow, it's associated with merchandise imports. So if the merchandise trade balance is negative, it means we've got a trade deficit. But in the opposite is that if it is positive, then this translates to a surplus. Services. All the services Zimbabwe exports or imports, or sometimes we may export services, like teaching services, legal services, and other types of services. Goods and services balance. Services and merchandise trade account. If positive, it means we've got a surplus of goods and services transactions. If negative, then we've got a deficit of goods and services transactions. So the goods and services balance will be adding the two balances, the balance of trade and the balance of the invisible balance associated with services. If it is positive, it means we've got an excess of exports of services over imports of services and goods, because it's a combined thing. And then if it is negative, then we've got a deficit. Imports will be greater than exports. So we subtract from GDP. In the first scenario, we add to GDP. So income, receipts, and payments. Net earnings such as dividends, interest, and profit payments on Zimbabwean investments abroad. They come to us as net property income from abroad. These are earnings on Zimbabwean investments in other countries, minus payments on foreign assets held by citizens of other countries, which will represent an outflow. And then we've got compensation to employees as well, which needs to be considered. And then we've got unilateral transfers, which are not associated with an exchange of goods and services. This is the transfer of goods and services, gifts of some kind, financial assets, money gifts, between, say, the United States of America and the rest of the world, or in the context of a person like myself, between Zimbabwe and the rest of the world. We've got private transfer payments and also governmental transfers as well, to honor certain obligations, but not necessarily because of goods and or services with market value, which the government will be transferring money for. That's why they are called unilateral transfers. The current account balance is a balance on goods and services, which includes net unilateral transfers and net investment income. So it means we take investment income from abroad and we subtract from it net investment income to abroad. And then we get a balance, which is called net investment income, which is added to the balance on goods and services. And then finally, we add net unilateral transfers, which are transfers from abroad minus transfers to abroad, which is net unilateral transfers. So if we add the three balances, we get the current account balance. And then going to the capital and financial account, it records all purchases and sale of assets and private sector or official transactions. So the private sector financial transactions include direct investment, the purchasing or the sale of securities and bank claims and liabilities. So the balance of payments, when we have a credit, it means capital and financial flows are actually inflows. It leads to the home country receiving payments from foreigners, and the exports of goods and services are associated with the credit. Yet the opposite, which is the debit, which is associated with the minus sign, capital and financial outflows will be taking place. It leads to foreigners receiving payments. It's associated with import of goods and services. Official settlements transactions. It's associated with movement of financial assets among official holders. Official reserves assets, liabilities to foreign official agencies. And then we've got the official settlements transactions are associated with the official reserves account, which I alluded to earlier. And then the statistical discrepancy, it records errors and omissions, which are associated with compiling any information about the international trade transactions or balance of payments. We know there is under-invoicing of exports and over-invoicing of imports in a bid to externalize foreign currency or to externalize revenue from international trade for exporters. This leads to the under-reporting of the actual performance of the corporates and other agents in international trade. So the statistical discrepancy item takes into account that. So I've got an example here in table 2.1, in table 1 of the US balance of payments in 2008 in billions of dollars. It's an example which shows that the merchandise trade balance was 820, and it was obtained from subtracting, saying 1,291.4 minus 2,112.2. Because you are subtracting a bigger figure from a smaller one, the sign will be negative and you get 820. And then the services balance, we take all these services, we add to them, minus 61.5 plus 61.7, we get 0.2 minus 21.4, we get minus 21.6. And then we subtract from 160.9, we get 139.7. And then the goods and services balance, we just add the two balances, which is 139.7 and minus 820. you must be able to get a minus 681.1. And then the income balance comes from net investment income, and this net investment income, we add the investment income and the compensation of employees, which is recorded in the balance of payments. So if we take 134.8 minus 7.2, we get 127.6. And then for the net unilateral transfers, we've got US government grants, which were negative, which represents an outflow, US government pensions, which are negative, and then we've got private remittances, which are also negative. If we add all these negative figures, 77.2 plus 77.9 plus 34.6, we get 119.7, and then we put the negative side, which is the common sign of these numbers. And the current account balance is simply a summation of net unilateral transfers and investment income and the balance of own goods and services. And then the capital account, in this example, it had a deficit of minus 2.7 billion. And the financial account transactions that take place in the banking system were equivalent to 546.6 billion. The statistical discrepancy was 129.3 billion. The balance on capital and the financial account, taking into account the statistical discrepancy item, 673.2 billion. So since this figure is positive, we have got a positive figure of 673.2 billion. It cancels out the negative figure of the current account. It cancels out the negative figure of the current account, implying that the balance of payments balance at 0. So what we see is a surplus on services transactions, but there is a merchandise trade deficit. The overall situation is that there is a deficit. And then when it comes to the current account deficit situation, there is a current account deficit because of the excess of imports over exports. We've got an excess of imports over exports, which leads to a current account deficit of 673.2 billion. And then these are other figures that you can just consider in your discussion with your colleagues. They illustrate more of the same in summarized form of what we looked at, which is depicted on table number 2. I mean, on table number 1, which is on the slide. And then what does a current account deficit or surplus mean? We know that total debits are equal to total credits because of the double entry system. So if the current account registers a deficit, this implies that the capital and financial account must register a surplus. If the current account registers a surplus, then there will be a deficit in the capital account, in the capital and financial account. The current account balance, net foreign investment in national income accounting. And then we've got the current account surplus. There's an excess of exports over imports, goods, services, investment income, and unilateral transfers. There is net receipt of financial claims, improved net foreign investment position, position. And then we've got capital outflows, net supply of funds for lenders, which leads to the current account, or which is as a consequence of the current account surplus, or leads to a current account surplus. A current account deficit is associated with an excess of imports over exports in terms of goods, services, investment income, and unilateral transfers. Increase in net foreign claims upon the home nation, foreign capital inflows, net demand for funds from abroad, worsening of the home nation's net foreign investment position because of the current account deficit. Net borrowing of an economy. The net borrowing by government, which is a budget deficit, to exploit this when we're looking at private saving and the saving of government and how these relate to the current account. The excess of outlays, which are government expenses over tax revenue, which is T. So private sector net borrowing is the excess of private sector investment represented by capital letter I, over private saving, which is represented by capital letter S. So the budget position of the government, which is really G minus, it's supposed to be T minus G, but here we are saying government, it's a government deficit, implying that we are spending, G is greater than T, we are spending more than what we are receiving through taxation. And hence we have got a budget deficit when G is smaller than T. And then we've got private saving, the excess of private saving, investment over saving. It will be I minus S. So the current account would be in deficit, showing us that there is net borrowing, either from other countries. And then capital flows, they tend to move in sympathy with the current account. They finance a current account deficit. So the current account deficit is in essence driven by capital flows. Capital inflows keep the Zim dollar stronger than it would otherwise be. It boosts imports and suppress exports because people will be having disposable income to buy from other countries. If the commodities produced by other countries are normal goods, it stands to reason that economic agents will be buying more of those commodities. A current account deficit, it means not efficiently reversed by trade policies. It's not easy to reverse it through tariffs, quotas, and subsidies because other countries may retaliate, which may actually worsen the current account deficit. And the issues of the current account and its performance, they are linked to the business cycle. When we are in a recession, there tends to be a current account, say a deficit, ceteris paribus, which may improve with an upturn in economic activity. So what follows is just a characterization of the situation in Zimbabwe or in any other economy for that matter, because here we're just presenting principles. So the rest of the stuff you will read on your own. Thank you so much for attending this short lecture. I believe you benefited from this short lecture. When we meet next time, we're going to be looking at exchange rates, money, banking, and the price level. Have a restful day.